Hello, I'm Peter Herbert from Insight Training. Welcome to today's short session, one of a series we're currently running, looking at relevant aspects of accounting, audit, and company law that are particularly pertinent in the current economic climate. Today's session will focus on the accounting implications of government and other aid. Let me start, if I could, by showing my screen. Okay, it's a topic we're getting lots of queries on currently. The relevant section of FRS 102 that deals with government aid, government grants, is section 24. We've then got the equivalent section in FRS 105 for micro, section 19. We'll talk about those sections in quite a bit of detail over the course of the session. In some respects, the accounting here is fairly straightforward. In other respects, slightly less so. And we will drill down on some of those more contentious areas during the course of today's short session. Here's what we'll cover. We'll begin with the fundamentals. We'll talk about some of the accounting implications of the coronavirus job retention scheme. We'll then look at some of the accounting implications of the government-backed loan schemes. So CBILS, the coronavirus business interruption loan scheme, and BBLS, the bounce back loan scheme. We'll look at non-government grants and finish off with some accounting implications of modifications to rent agreements. Not a comprehensive list of all the sorts of aid available, but those that are creating most issues on courses at the current time. Okay, let's begin with the fundamentals. So, section 24 of FRS 102 deals with government grants and makes clear that you only recognise a grant in the accounts when the entity concerned will comply with the related conditions and when the grant will be received. Now, two approaches to accounting here: the performance method or the accrual method. The performance method means that you recognise the grant income in your P&L when you meet the relevant conditions. The accrual method, where you receive monies up front, you debit bank, credit deferred income, and then release that credit back to P&L to match off against the related costs. A complete accounting policy choice there in relation to FRS 102. When it becomes clear that you'll need to repay a grant you've received, you then have to recognise that in your accounts as a liability. We are mindful in the current climate that certainly in the context of, for example, the coronavirus job retention scheme grant, it may well be that applications that have been made for this grant have been done incorrectly. It may well be off the back of HMRC audits that have been done. It transpires that monies are repayable, and therefore very important to remember that in that context, if you realise as an accountant or an auditor that there is an obligation to repay, the provision is made in accordance there with section 24 of FRS 102. Disclosure-wise, here's the range of disclosure requirements in FRS 102. So you're required to have an accounting policy note. You're required to provide details in the notes of the accounts of the nature and amount of grants. That may well, I guess, for an entity applying FRS 102, take the form of a list of different types of grants received and the amounts concerned. So key will this, of course, be to so many entities in the current climate. You're required to articulate any information relevant about unfulfilled conditions and other contingencies, and also provide an indication of other forms of government assistance other than grants from which the entity has benefited. And we'll talk about one or two of those briefly during the course of today's session. So the disclosure, I think, will require very careful thought. For those of you that are getting involved in preparing or auditing accounts in accordance with FRS 102 Section 1A for small entities, you'll need an accounting policy note. Nothing technically over and above that, but you will need adequate information to inform that a true and fair view prevails. Under FRS 105 for micro, although the accounting principles might be very much the same as they would be under FRS 102, there'll be no disclosure required. That's not an imposition really at all within FRS 105. Okay, so a quick run through the fundamental accounting principles there and a bit on disclosure. Let's now have a look at some specific stuff around the accounting treatment for the CJRS grant. Now, what I'm not going to do is talk about the technicalities of how the grant scheme works, but let's run through some of the fundamentals of the accounting here. So entitlement for CJRS will accrue for each day furloughed. Okay, so entitlement accrues over time. What you would do from a practical point of view and from an accounting point of view here is you'd run the payroll and accrue for the payroll costs in the normal way, And what you would then do is bring the grant income in and match that with the payroll costs in the P&L. The sense we're getting in relation to the way that the CJRS works is that when the grant application is being made, organisations are being paid on a pretty timely basis. We would therefore expect to see here minimal balance sheet impact, but in the P&L, very important to remember, I think, that per paragraph 2.52 of FRS 102, that you would not net the grant off against the relevant payroll costs. You would show that grant income separately as other income in your P&L where you apply for it. And yes, accounting policy choice, you've got, as you mentioned on the previous slide, the option to use the accrual method or the performance method for grants under FRS 102. The key thing to bear in mind, going back to the first point on this slide, is that the entitlement accrues for each day furloughed. So even if you're using the performance method, not the accrual method, you will basically bring the grant income in over time as the entitlement builds up. And that fundamentally means that whether you use the accrual method or the performance method, you do get the same answer from an accounting point of view. Now, under FRS 105, there's no accounting policy choice available. You have to use the accrual method. That will therefore mean that under FRS 105, you get exactly the same accounting treatment as you would under FRS 102 when you're bringing Coronavirus Job Retention Scheme grant income into your P&L. Okay, let's look at a scenario. So A Limited has got a 31st of March 2020 year end. It claims 20,000 under CJRS for the last week of March. It can't afford to pay the wages until the CJRS is received. The money's received on the 15th of April, at which point the wage payment would be made. Now, the way that I work from an accounting point of view is you'd run the March payroll as normal. You clearly would not be paying March's wages in March because you can't afford to. What you would therefore do is to accrue, so debit profit and loss account and credit accruals. What we're saying is we believe here have the entitlement to the CJRS grants, and therefore, even though that grant income had not been received within the accounting period, that will get accrued at the year end and therefore credit P&L and debit other debtors. So as mentioned a minute ago, limited impact here on balance sheet, but there will be some, and that could certainly be a relevant issue, I suppose, for a 31st of March 2020 year end. Okay, let's then move on and look at some of the accounting implications of these government-backed loan schemes. Now, as I say, there are two schemes out there that most SMEs will deal with or see or use: the Coronavirus Business Interruption Loan Scheme, or CBILS, and the Bounce Back Loan Scheme. Yeah, I guess what we're going to look at with our example shortly will be the BBLS, the Business Bounce Back Loan Scheme. The accounting treatment for the two is pretty similar. I guess the key thing to bear in mind in relation to these schemes is you're going to have the schemes operated effectively through a high street bank, and therefore the bank will be providing the finance. The government will provide a guarantee, and in the case of the bounce back loan, that will be 100% guarantee that really incentivizes the bank to want to lend. Very limited scope from the bank's point of view for personal guarantees, particularly with the bounce back loan scheme where those guarantees would not be available. And what we'll come on to and look at shortly from an accounting point of view is the implications of the linked grant here, as it were, the business interruption payment, where what the government will do, whether it's the bounce back loan scheme or the CBILS scheme, is they will provide funding effectively for any related charges and also for the first year of interest. And that's what we tend to refer to as the business interruption payment or the BIP. So here's how it works, and here's the related accounting issues. So the BIP, the business interruption payment, will go straight from the government to the bank, where the view is taken by the entity, and we'll look at an example shortly, that BIP payment will constitute a grant. Then what you'll do is charge interest as normal through the P&L as the reporting entity with a matching income entry in relation to the grant, or what we might call gross up for interest and related grant. And we'll see that coming through shortly with a more detailed example. One of the other points that has been floated, I think, certainly in relation to these schemes, is that because the bank will probably lend at a slightly cheaper, slightly lower rate, because they got the government backed guarantee in the background there to provide that support, does that therefore mean that these loans are what we might call non-market rate loans? And what I'm sure you'll recall from an FRS 102 point of view is that when an organisation borrows cheap and is paying a lower than market interest rate, what you're required to do from an accounting point of view is take future payments to the lender, discount them back to net present value using a market rate, and you then get on day one a gain, which in the context, I guess, of this particular sort of arrangement might be construed as being the grant. Now, again, that is something which is certainly worth conjuring with and contemplating from an accounting point of view. The view I certainly hold on this one is that given that these schemes are widely available, it may well be that bank is allowed or able to lend cheaper because they've got the government guarantee in the background, but these are schemes that are widely available, and therefore these slightly lower rates are indeed market rates. So my view in the short term here is that this will not be an issue for organisations. They will not need to worry about discounting these loans back to net present value using a different market rate, but there will still be ramifications here about the accounting treatment for the BIP. Okay, let's have a look at an example. So B Limited borrows 50k under the bounce back loan scheme. Repayments are due annually in arrears, and interest is payable at 2.5%. These are the standard features really here of the bounce back loan scheme. Well, let's have a look, if we could, for that example, about how the cash flows will work over the 6-year period, which is the standard period for a bounce back loan. So the initial loan amount is 50k. There's no interest charged in year one. There's no repayment of capital or interest in year one, and therefore at the end of year one, the opening balance of 50k becomes the closing balance. We then roll it through the remaining 5 years. We accrue interest year on year at 2.5%, the fixed rate for the bounce back loan scheme. And we then effectively got a total of £3,812 interest over that 5-year, effectively 6-year term in total. And you've therefore got repayments of 53,812 in equal instalments of 10,762 beginning from year 2. So that's the way the cash flows work. I guess the interesting thing from an accounting point of view here is how do we deal with the fact that in that first year, there's no interest charge, because quite simply what's going to happen is the bank's going to provide that interest by the government, and that will not therefore be a cost which the organisation needs to actually incur. Now, I think the way that a lot of people interpret that is that the way the arrangement would work, you do still have the basic loan agreement between the bank and the borrower, and contractually based on that agreement, the borrower is liable for all the interest. You've then got a separate side agreement going on, which means what the bank's agreeing to do is basically step up and provide that interest for the organisation for that first period. What therefore I think will be a good way to go from an accounting point of view here will be to account for the interest in the company's books in year one as if it were being paid by the entity. And I guess if you're taking 2.5% of 50,000 in year one, that's 1,250. We're going to therefore debit that amount to the P&L accounts. That will, of course, though, not be an amount the entity has to pay, because quite simply what's going to happen here is the government will pay it instead. What we're going to therefore have as the other side of the entry is a credit to basically other income, essentially being the support the government's providing to provide that income to meet the interest cost. What we're going to therefore do, I suppose, essentially, is what you might call gross it up and show an equal and opposite interest charge and income amount reflecting the interest, which is contractually payable there, but that the government's paying on the entity's behalf. And that's the way the accounting might work. Okay, so recognize a year one interest payment as if there was no BIP at 1,250 and an equal and opposite credit entry in the P&L, that being the same amount and that being the grant income the government's providing to support the company in that first year in these very difficult times. Now that is a suggested approach. It's not the only approach. Here's a different approach, because I guess what some people might say, well, actually, in the context of the arrangement here for this bounce back loan scheme, we might take the view that actually in no way, shape or form is the entity liable for interest in that first year at all. And that first slug of interest, therefore, should not in any way, shape or form be charged to the P&L account. What we've effectively got here in reality is what you might call a tripartite agreement between the entity borrowing the money, the bank and the government, whereby the government is contractually liable for that first year of interest. All we're going to therefore do from the entity's point of view is take the remaining interest, the 3812, spread that in the P&L over the 6-year term. But because we're spreading 5 years interest over a 6-year term, we will have a lower effective rate of 1.86%. We do still have, though, of course, in years 2 through 6, the same equal payments, totaling 53,812 over the remaining term of the loan. So that's the alternative approach you could have there, where you take the view it's actually a tripartite agreement. There's no contractual obligation on the entity, and you therefore spread over the full 6 years the remaining interest of 3812. Now, it's not cast in stone. The different approaches remains to be seen as time goes on how this actually plays out. But that, to me, is the two approaches you could adopt. I think, if anything, in my mind, certainly for the CBILS loans, I lean more towards the former approach. But as I say, given it's not categorically nailed down in 102 how you tackle it, that could well be the way to go. And you could very much have that alternative approach as an equally viable alternative. Same consideration under 105 here as 102 in relation to the accounting there for that interest in that situation. Okay, let's move on and have a look at non-government grants. Now, there's no hard and fast rules about how you account for non-government grants. FRS 102 section 24 deals with government grants. FRS 105 section 19 deals with government grants. I guess my sense has been this last few weeks, since these non-government grants emerged, though, in the context where we currently are, it probably would make sense to account for them in much the same way that you would government grants, in the absence of any more detailed rules about how that might work. And here, therefore, is my example. So, Music Fund provides support for the creative sector, consisting of small grants, first 5,000, and interest-free loans between 5 and 10,000 to support small businesses. Now, again, I guess the loans are loans, the grants are grants. We talked already about the fact that under 102, you've got two approaches in terms of how you account for grant income. Do you actually recognise it all in the P&L at the point that amount becomes receivable, or do you credit to deferred income and release back? One very important paragraph to be aware of in the context of 102 and 105, where grants are provided to provide immediate financial support for organisations in financial distress, is paragraph 24.5e of 102. I'm summarising that on this next slide. So paragraph 24.5e of 102, paragraph 19.8 of 105 says that a grant that becomes receivable as compensation for expenses or losses already incurred, or for the purpose of giving immediate financial support with no future related costs, when you're applying the accrual method, shall be recognised in income at the point at which it becomes receivable. So that, again, to me says that whether your accounting policy choice is one whereby you use the accrual method or where you use the performance method, where that grant's being provided to provide immediate financial support and there's no specific costs that that grant relates to, you will get the same accounting approach and you book it in the P&L at the point at which it becomes receivable. And again, the same thing would apply, therefore, in the context of FRS 105. So with that in mind, therefore, with my music fund grants, 102 or 105, recognise when receivable. For the loan, again, I think the preamble to the scenario talks about the loans being cheap. Do we again have to discount that cheap loan to net present value using a market rate? We end up with a day one credit that might be construed as being potentially effectively a grant. But again, I would certainly say that in the context of sort of situations we're currently looking at, where these loans that are relatively cheap are widely available, one might well still very much argue that these indeed are the market rates, and therefore you'll account for the loan at face value in a 102 world in the same way that you would under 105. My sense, certainly in relation to discounting non-market rate loans to net present value, it's much more of an issue, much more of a thing where the loan's from a related party, and that's why it's cheap. I think in this context, less so. And therefore, I think, again, from a loan point of view, 102 or 105, the accounting approach very much the same in both situations. The last thing I wanted to pick up, if I could briefly, on today's short session is modifications to rent agreements. Now, there are a range of different sources of aid available to entities in the current climate. I've not covered in any way, shape or form here the top 5 are on that list, limited in time. But as I said, the one that I think is interesting in terms of accounting issues is the bottom one, where you've got a situation where maybe because an organisation is in real financial distress, what its landlord decides to do is to give it a rent holiday. Now, that is not government aid as such, but it is a form of aid. And yes, it is creating some interesting conversations really about how the accounting should work in practice. Let's look therefore at a final example that draws that point out. And here it is. So C Limited runs a chain of shops. Due to it having to close in the light of the pandemic, C Limited's landlord has waived 3 months' rent. Now, approaches here, you could, I guess, in the first instance say, well, in the months where the rent's being waived, we'll quite simply charge nothing through the P&L. That would certainly be the way you would approach any holiday you got in relation to business rates in the current climate. In those particular months where business rates are not being paid, just don't put a charge through the P&L. Same idea, I guess, here potentially with the rent waiver. But I guess what people are thinking about in that context is that if we've got a situation whereby a landlord saying to a tenant, over the next 3, 4, 5 months, you do not need to actually pay any rent, is that in fact a lease incentive? And should we therefore be spreading that forward in the same way that you might any other lease incentive? Now, lease incentives defined in the glossary of terms to FRS 102 and the glossary of terms to FRS 105 as an incentive to enter into a new lease or to renew an existing one. Now, to my mind, this particular dispensation here, whereby the entity concerned does not need to pay rent, is not necessarily going to incentivize them to enter into a new lease or a new and operating lease, an existing lease, but maybe in the context of what we're looking at here, it feels that in substance it looks much like the same thing. There is therefore potentially some scope, I guess, to think about the potential here for an appropriate treatment being to spread forward the cost in the landlord's books, the benefit in the tenant's books of that incentive over the remaining lease term, as you would ordinarily do under FRS 102 or 105, or what you could alternatively say here is, look, because 102's definition of what an incentive is all about does not deal with that particular situation where you're modifying the terms of the lease without it being an incentive as defined, the easier and different approach might be in the months concerned, we quite simply have no charge or no credit in the P&L, then whether you're the tenant or indeed the landlord. And that, again, is a situation whereby there clearly will be judgment to apply. It's not covered off specifically in FRS 102 or 105. There will therefore be an accounting policy choice to be made, and we have to decide up to individual organisations to decide how to tackle that going forward. I guess in a 102 world, what will be really clear is to be very transparent about the approach adopted here, particularly where the impact on the accounts will be material. Okay, so we've done a few different considerations there around the accounting aspects of some of the different facets of government and other aid. Just a few final takeaways to finish off the session, if I could. So yes, some accounting treatments, as we've seen in relation to some of those loan support schemes and maybe the rent modifications, are not absolutely clear cut. Remember that when it comes to grant income, sometimes, and again, I'm thinking about things like CBILS, again, I'm thinking about some of the grants provided for immediate financial support, whether you use the accrual method or whether you use the performance method per FRS 102, you might find you get a very similar, if not the same answer. Remember that if you are looking at 105 specifically, no accounting policy choice, only one option available for grant accounting, and that's the accrual method. And finally, as mentioned right at the start of this short session, do watch for situations where maybe, certainly in relation to the CGRS, you do have some sort of breach. There will then be an obligation to repay, and that, of course, should be provided for in the accounts as a result. Okay, hope that was useful. You can get a download of the slides if you want it by emailing us at inquiries@insight-training.biz. Do also contact us with any other feedback on this session today, and any other ideas for future sessions you think would be useful. By looking at our website, www.insight-training.biz, you can get more information on our forthcoming series of live interactive sessions running throughout the spring and summer of 2020. And do have a look at www.onlinetutors.co.uk. There's some excellent content there from Dean Wharton, including, importantly, lots of detail around the practicalities of applying the CGRS scheme we talked about from an accounting point of view during today's short session. Let me finish, if I could, by just stopping my screen share and saying thank you for listening. Hope it was useful, and look forward to speaking to you all again very, very soon. Thank you and goodbye.